Welcome to the Kaiser Report. I'm Max Kaiser. Now, according to the Guardian newspaper, a former manager at the Royal Bank of Scotland impersonated a bond trader at the bank after losing his job in its property services division. Yes, KK Ho printed business cards describing himself as a bond salesman with which he attended internal meetings and met customers. Also in the UK this week, Mark Carney attended a press conference where he impersonated a bond trader by offering to buy more gilts should unemployment rise. He also did an impression of a property speculator when he promised to keep rates low, at least until 2017. Let's all talk about it more in depth with Stacey Herbert.
Yes, Max, we've seen quite a lot of impersonating happening in the headlines this week. And of course, yes, Mark Carney earlier this week, he was speaking to the press. And Twitter reacts, is Carney a banker or a lawyer? So he introduced so many escape clauses to his forward guidance. Some people were asking whether or not he was indeed a lawyer. But Faisal Islam also tweeted this chart, and he says, here's the boom in the UK. As you see, this is production and manufacturing, that little tiny blip at the end. He says, Mark Carney must think we're all bonkers.
Yeah, KK Ho. I like that name, KK Ho. Mark Carney is a ho. He's a ho for the bankers who pimp him out to go before the people in the fine country here of Britain, and he'd be talking lots of smack about keeping interest rates low, as if he can control which way the bond market is going. Sure, they can for a while, and they can manipulate interest rates, and they can suppress the price of gold by dumping 1,000 tons or more of UK's gold. But eventually, it all comes down the wash. Interest rates skyrocket. Mark Carney is taken out of this country on a rail and laughed out of town, as he rightfully should, because he's a used car salesman. He is a suppository salesman. He's a sphincter spreader, a grande from some military penal colony in Canada somewhere, and he escaped. Talk about escape velocity. This guy escaped from a military penal colony somewhere in Canada where he got hit in the head with hockey pucks all day, and somehow he made his way over to the Bank of England.
Well, at least with the RBS story, the guy who impersonated a bond trader.
KK Ho!
KK Ho. According to RBS, he had not performed any regulated activity, nor had he profited, they don't think, anyway. From
There is no regulated activity at RBS! Nothing at RBS is regulated! It's an open sewer of fraud. RBS, open sewer of fraud. There are no regulations.
Well, speaking of open sewer fraud, you know, Mark Carney is here heading the Bank of England. But he did escape from Canada before it was all too late. CMHC moves to take steam out of housing market. Canada Mortgage and Housing Corporation is limiting guarantees it offers banks and other lenders on mortgage-backed securities. The measure comes amid the federal government's efforts to protect taxpayers from financial risks in the housing sector, further cool lending, and add upward pressure to mortgage rates.
I wish I had one of those helium-filled balloons. You know, when you, on the helium-filled balloon, and your voice gets really cracky like this. Because this is really, anytime you hear the words Mark Carney, think about a clown at a sideshow named Kiki Ho, who's sucking on a helium-filled Jimson and speaking in that childlike, whiny voice of somebody who's either A, completely smacked out on heroin, B, needs to have a lobotomy, or C, currently runs a Bank of England.
Well, over in Canada, as we know, the housing bubble is getting ready to burst, it appears. Yeah.
Well, yeah, Canada, you blew a big bubble in Canada. Now it's crashing. It's not hard to blow a big bubble. If you, look, let me explain something about humans and dogs. If you leave out enough dog food, they'll eat themselves to death. If you jack interest rates down to 0%, they'll speculate themselves to death, and the bubble will pop. That's not, it's not, so what? You get paid on the amount of dogs you murder, the amount of consumers and lenders you destroy. That's how you're getting paid. That's a business model based on a genocide. It's interest rate sensitive genocide. There's an interest rate apartheid. Mark Carney is this deranged psychopath from Canada who blew an enormous bubble in Canada, and now he's here with KK Ho to blow it all up on this show.
Well, the CMHC has notified banks across Canada that they're going to lower their maximum guarantee for these mortgages. And the decision comes in the wake of unexpected demand for the guarantees. Of course, you know, the government guarantees to use taxpayer money to back their housing speculation and flipping schemes, and of course they all went for it.
You know, I have an experiment. Go to a Walmart and open up a van, and inside the van are an unlimited supply of donuts. And then go into the parking lot in front of these big, fat, waddling Americans and say, all the donuts you can eat. Now, do you think, what am I talking about? They already have those sales at Walmart where people trample themselves to death to get discounts on donuts and eat themselves into obesity. Same thing in Canada. So here you're saying, oh, if we put interest rates down low enough for the white people, meanwhile, the black people have to go to payday lenders and spend 30, 40, 50, 60%. But if you're a white guy, oh, it's 0% for you. All the interest you can get. Speculate yourself to death. Woohoo! Kick-a-ho! I'm Mark Carney.
Well, speaking of guarantees, however, there's, of course, many market participants now on Wall Street like guaranteed profits. They don't actually like to have to compete or take any risk, remember?
No more risk. No, I don't want no risk. You know, I don't have to take no risk because I got my hose down there on Wall Street. And I've been pimping my mortgages for Goldman Sachs and JP Morgan. I didn't take no risk. That's not my thing, baby.
You mean the KK hose?
The KK hose. Because we got another real estate bubble to come.
Well, gold futures dropped in milliseconds before ISM report. About 90 milliseconds before the 10 a.m. release of an Upbeat Institute for Supply Management report about U.S. service sector companies, the price of gold futures and gold ETFs fell. Specifically, at 9:59:59 and 904 milliseconds, gold for December delivery dropped almost $2 a contract from 1308.90 to 1307.
Yeah, gold is like an underage prisoner at one of America's federal penitentiaries on day one in the shower. It doesn't have a great future ahead of it. Until such time as they burn that prison down. You know, I'm saying the bond vigilantes come in and they burn Carney and his real estate popping hose down. You get two things. Bonds collapse, as they should, because there's about a 14% global inflation rate adjusted for reality. And if you remove the suppressant on gold, like Bank of England over there at Mark Carney, he sells 1,000 tons into the market or more to suppress the price. Gold goes to $5,000 an ounce. But we got to wait. We got to wait for the prison to be built down. We got to wait for justice to be served because we got to wait for this pimpin', whoring Mark Carney to get his mojo eviscerated by reality, which is coming.
Well, the KK hoes in this situation are the guys who are impersonating real participants in the market, when in fact they were just front running. So here the story is suggesting that Thomson Reuters was feeding them, again, a few milliseconds. It only takes a few milliseconds before they can front run the whole market.
Let me explain front running for the global audience, in particular Americans. Imagine there's a donut glazing machine, and through it, like Krispy Kreme, and through the donuts, and they're going to put a nice layer of sugary glaze. You have advanced knowledge, and you can put yourself on the conveyor belt and actually open up your jaw like this. I don't know if you're catching this on the yeah. And you can front run the sugar pouring out of the free machine. See, that's what front running is. You're drowning yourself in the free sugar before anyone else gets on the donuts. Okay, Americans? Do you understand what that means? That's why you're big, fat, and stupid, because you're front running your own donut shops.
You should call that donut chain the KK Ho Shop.
I'm going to start my own chain of topless donut shops called KK Ho. It's going to put, Tim Hortons up there in Canada. They got a donut shop. I'm going to put him right out of business, along with Mark Carney. Go back to Canada, you hockey-damaged moron.
And so finally we move to a headline from James Howard Kunstler, and it's called The Dreadful Summer Wind. And he's basically talking about the US dollar as an impersonation of a global reserve currency, and the American people and administration as an impersonation of a global empire. So the USA is veering into a psychological space not unlike the wilderness of mind that Germany found itself in back in the early 20th century, the deep woods of paranoia where our own failures will be projected onto the motives of others who mean to do us harm. So he's talking about them losing control of all the systems and structures they set up in place, whether it's the edge of the military empire or the edge of the financial empire that they have. And he says, and we've tried to offset the accelerating losses of running our unrunnable stuff with accounting fraud aimed at pretending that everything still works. But the accounting fraud has only accelerated the gathering disorder in the banking system, he says. Max, that disorder has infected our currency, and the infection is spreading across all currencies. What a surprise that the first pandemic to strike an overstressed global immune system was not bird flu after all, but a sickness of money. And the sickness of money he's referring to is the April smash of gold and silver.
Well, James Howard Kunstler is a fine writer. And I read that piece, and he was talking also about what he foresees happening this fall, September and October, when people come off the beach in the Hamptons, return to their desks, and they see that the world is on fire and that they're not properly hedged. And then they go into panic mode, and they say, wait a minute, we've got some hockey puck damaged moron running the Bank of England. I better get out of this market. And they start selling in a panic sale mode, and bonds seek their rightful level of about 8-9% on the 10-year in the G20 and about 20% in various other countries. And of course, then we'll have global Armageddon, which, prepare yourself.
Well, he's saying as well that the U.S. dollar is the KKO of global currencies, because he says near the center of that money sickness was the blitzkrieg against gold and silver in the spring, when errant serial selling dumps were executed against the money metals to unmoney them. So gold and silver are the only true money. The dollar has posed as the one true money. They act as if they're as good as gold on the global gold standard, and yet it's being exposed in terms of KKOdom. They've actually
KKOdom.
They've actually been profiting from this KKO impersonating a currency scheme.
Well, you mentioned Faisal Islam earlier, and he was at the press conference with Mark Carney. And I asked Faisal on Twitter, and he hasn't responded yet, why he didn't ask Mark Carney about the 1,000 or 1,500 tons of gold that the Bank of England sold recently to force the price down. And this is gold that they hold for other countries. So German gold, Austrian gold, Australian gold, various gold holdings around the world stored at the Bank of England. Bank of England sold these other countries' gold to force the price down. And this has been documented by folks over there at goldmoney.com. And Alistair McLeod, for example, has a real kind of a forensic look at the numbers. He talked about it on this show. I'm still waiting to get some answers.
So you're still waiting because maybe Faisal Islam is in on KKO Mark Carney's scheme.
Faisal KKO Islam. Well, where's my tweet back, buddy? Where's my tweet? Over there, Channel 4. Anyway, what am I rambling on about? Stacey Herbert, we got to go. Thanks so much for being on the Kaiser Report.
Thank you, Max.
Don't go away. Welcome back to the Kaiser Report. I'm Max Kaiser. Time now to go to Gainesville, Georgia, to talk with Robert Prechter, author of Conquer the Crash. Bob Prechter, welcome to the Kaiser Report.
Yeah, it's good to be here. Thanks, Max.
Okay, let's talk about this idea. You call yourself a one-handed economist who sees no chance of inflation, that deflation is our future. So speak about that a little bit.
Well, I think the big problem is debt. There's $55 trillion worth of dollar-denominated debt. When you go around the world and add up the debt, it comes to about $200 trillion. When the government ran out of steam pushing home ownership debt, they started moving over to students and trying to push student loans. Those are now up to $1 trillion. When you add $84 trillion worth of unfunded liabilities of the federal government, when you look at perhaps $1 quadrillion worth of what I call IOU ifs, which are derivatives, I think the debt burden is so great that it's unpayable no matter what anyone does, including governments and central banks. So I think it's going to go the way of all over-indebtedness, which is deflation. I think we've got some signs of it as well in the background. But so far, the central banks have been pretty successful in keeping things about flat.
Okay, so you're talking about debt, the enormous debts, the fact that debts that can't be paid won't be paid, and that bonds default, that goes belly up, and there's this depression, deflation going on. And there's a background with this also. For example, my friend Peter Schiff in Connecticut, he does a very good job in breaking down some of the consumer price indexes and shows that, the government doesn't really track things like magazines or education or other elements of the consumer price mix. And if you were to actually look at stuff that people buy and trade on a daily basis, the inflation numbers are creeping up. They're more like 8 or 9%, et cetera. So there is, can you speak about a little bit about that, Bob?
Sure. Of course, we know the government manipulates figures. The inflation rate in terms of consumer price index is higher than they report. But look around you. I mean, gold is off $600 from its high. Silver's down 60%. This is the metal that was supposed to go to $200 an ounce is 20 bucks. You look at interest rates, and for the past 10 years, the hyperinflationists have been saying, oh, with all this money creation, interest rates are going to be in double digits, and they fell to the lowest level in history. And this was right along the predictions we were making. You look at commodities, they've been languishing since 2011. All kinds of indicators to me show that there is not the response that the hyperinflationists were expecting. And this is in the face of the Fed inflating the base money supply at 33% a year. That's just huge. So obviously there are tremendous deflationary pressures that are countering this inflation of base money. But my argument goes a lot deeper than that. I think the banks don't want to go bankrupt. And a lot of people said, in fact, Bernanke himself promised that he would drop money from helicopters. And is that really what they've been doing? Well, in 2008, they pretty much did that. They supported all their buddies, willy-nilly during that period. But very rapidly thereafter, they traded all that debt for U.S. government bonds, government-guaranteed mortgages. So they're doing the same thing the Fed's always been doing, which is buying the safest possible debt. They're not going to go up and buy all the bad corporate debt or all the bad mortgages that are owned by the banks. Now, something that I more or less anticipated, I think shocked a lot of people, was what happened in Cyprus. I mean, where was all the money printing? Where was the central bank, the ECB coming in, on a white horse saying, we're the lenders of last resort? Where's the money dropped from helicopters? What they did was they came into the country of Cyprus and basically said, we are seizing your bank accounts. In other words, we're not bailing you out, we're taking your money. These are still bankers at heart, and they don't want to go under. They don't want to go bankrupt. They're not giving money away. They want to be paid back. I think eventually the same thing is going to happen in the United States, that there's no such thing as magic money, no such thing as infinite credit. And when this thing rolls, it's going to be a sight to see.
Okay, well, that's a really good point. I want to focus on this Cyprus situation as you described it here, because, and to give some context here, what you're saying is that the reason we've had these programs like quantitative easing is because when when bonds are due to be rolled over and matured, there's not enough economic growth to support a normal functioning bond market. So the government has got to come in and buy their own bonds. They've got to print money and buy their own bonds. And they're doing this in the hundreds of, trillions of dollars because there is this ongoing deflationary rollover of these economies. And so for those who say, as I just described, that there are countervailing inflation evidence in the consumer price index, your point, I just want to repeat the point, is at some point you end up at a Cyprus where, the banks just say, forget it. It's a bail-in. We're just taking the assets. And that's the risk, is that type of Cyprus-like bail-in or wealth confiscation spreads throughout Europe and spreads around the world, correct?
Yes. In fact, the people who run Europe have already warned Spain and Portugal and Ireland and Greece, look, if this happens to you, we're going to raid depositors' accounts. So, will the FDIC pay back everybody? I don't think so. The Fed has said several times that they want the government to get their houses in order so they can shore up the banks here in the United States. I don't think the Fed is going to do it, and I don't think the FDIC can do it. So I think we're in a real crisis period. And Cyprus was a little glimpse into the future, just like 2008 to me was a glimpse into the future. Shot across the bow, told us what it's going to be like when things do implode. Okay, well
let's take a look at the United Kingdom for a second, because Mark Carney just took over as Bank of England, and he's saying that they're going to keep rates low for the next couple of years, a so-called forward guidance. He sees recovery, and by recovery he means an improvement in house prices and stock prices. I think you would characterize that as speculation. But going forward, I think if what you're saying also is that these are very unhealthy policies because you're fostering economic misallocation of capital with interest rates at this low level to fight this inflation, and that at some point the UK is going to be facing something very similar to what happened in Cyprus, and that the creditors just come in, they seize wealth, and there's a bail-in, and these banks in the UK, They're zombie banks. Can you comment on the UK banks, Bob Prechter? I don't know if you've done a lot of work on UK banks, but are their balance sheets as impaired and dangerous as I have said and others have said, that they're just basically, it's a huge Ponzi scheme? Your thoughts?
Well, I agree with that entirely. But let's start with the idea that he's promising interest rates will stay low and they'll keep them low. I don't think they have the power to do that. Recall, it was December 2012, last year, when Bernanke came out and said, our QE policy is designed to keep long-term interest rates down. Well, they had already started up in the summer of 2012. They've been soaring ever since he made that comment. So obviously their policies aren't working as designed. All of the machinations that they're going through are leading to a weaker and weaker and weaker situation with greater and greater debt. The more they keep the bad guys liquefied, the more debt expands. And you're getting some of these things like we talked about before, like student loan debt and private equity companies, paying themselves through more and more ridiculous bonds that aren't going to be paid off. So the situation gets worse and worse and worse, and I don't think they can ultimately control it. I think ultimately the market is going to start demanding higher rates. And this happens in countries that are in trouble. It certainly happened in Greece before things blew up there. So rising interest rates to me are not the result of an extremely healthy economy, which is what most economists think. I don't think they're an indication that hyperinflation is coming, which is what most of the bears think. I think the rise in rates now that surprised the Fed and virtually everyone else are the early hint that all the debt's in trouble. And people are going to start demanding higher rates because they're going to start worrying about principal. Now, this is pretty much off the radar, because if you look at the sentiment indicators in the U.S. stock market, they are off the charts and have been for 5 months. In fact, we follow up to 22 different sentiment indicators, every one of which reached extreme record highs or matched record highs being 2007 and 2000 in the past 4 months. So we're back at another 2000 juncture, 2007 juncture, when people are absolutely optimistic about potential stock market gains. They're buying junk bonds like crazy. In fact, even though we're off the highs in junk bond prices, the sales have continued to be very, very strong. So the optimism and confidence out there is tremendous. It's historic, and it's the same level it was in 2000 and 2007. So we've got a double whammy coming. Too much optimism means people are taking all these investments on. And the second one, as you pointed out, is the underlying system is rotten and isn't going to be able to support these debts and the interest payments, or eventually, I think, even the principal payments.
All right, let's talk about the bond market here for a second, because the rate on the 10-year bond, and this is the bedrock bond that all other mortgages and credit-related instruments kind of sit on, this 10-year bond, the government bond, whether it's the UK or the US. Last year we're saying they were 140, 150 on the 10-year bond. Now they're 250, 260. They're moving up. What you're saying is that, and this is interesting because we're going to tap directly into the Elliott wave phenomenon, because the Elliott wave phenomenon, or technical analysis, looks at historical chart patterns and price patterns, and there's also a bit of, how do I describe this? There's a recurring theme in human nature that you see. Humans tend to go through periods of enormous optimism at the top and enormous pessimism at the bottom, and so your work tries to tap into that. Do you see, Robert Prechter, just to repeat on this, you're saying that rates now have bottomed out, you're looking for rates to rise, and so therefore bond prices commensurately are on the decline, which of course has huge implications for the banks and the economies. Bob, your thoughts?
Huge implications. One thing I'm very proud of is that a year ago, in the summer of 2012, Steve Hochberg, Pete Kendall, and I got together, put out our first joint special report out of Elliott Wave International here, and we said the 31-year bull market in bonds is ending. We're going to get into a very major period of rising interest rates. And as you just pointed out, this is the kiss of death. This is the black hole. When rates start to rise, this is where people start putting their money. So they stop putting it in other areas. And the higher rates go, the more it attracts money. Again, just like a black hole of magnetic force. So it's going to come out of the stock market. It's going to come out of commodities. It's going to come out of metals. It's going to come out of real estate, and everywhere just to go to borrowers who are willing to pay a higher and higher interest rate. It's very bad for the internal structure. Unfortunately, I think the monster that all the lenders, most of which are backed by the government, whether it's the Federal Reserve System or Fannie Mae, Freddie Mac, Federal Home Loan Banks, Ginnie Mae, Sallie Mae, you go right down all of these lists of agencies that have been pushing credit on the American people for all these years. And it's finally led to a point where the monster's too big to kill. And the only bullets they have are more debt. So you can't kill a debt monster with more debt. Ultimately, you know, we're going to reach an end game here shortly. And I think the extreme in optimism is one of the big signs, the warning signs that we saw before the last collapse.
All right, the legendary Bob Prechter, thanks so much for being on the Kaiser Report.
Thanks. And if I could add just one little add, if anybody wants to see the bond report we put out or my 20-page special on deflation, just go to ElliottWave.com. We're handing them out for nothing if you're interested.
All right, cool. Very good. And that's going to do it for this edition of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. And I'd like to thank our guest, Robert Prechter of ElliottWave.com. As you just heard about, he's got a special going on. If you'd like to get in touch, tweet us at Kaiser Report. Until next time, Max Kaiser saying bye, y'all.